What's up, future CPAs? Ready for an ultimate LCPA brain hack? We're about to tackle one of the trickiest parts of inventory accounting. Forget the boring textbook stuff. Today, we're zeroing in on what you absolutely must expense under IAS 2. Mastering this is a total game changer, so let's get right into it.
Okay, let me ask you something. What if the biggest mistake you can make on your inventory questions isn't about what you capitalize, but what you forget to exclude? It's a total paradigm shift, right? Everyone's obsessed with what goes in, but the real pros know what to kick out.
And look, the stakes here are crazy high. If you get this wrong, you're not just making a small mistake. You're literally inflating a company's assets and profits on paper. That's a huge red flag for any CPA, and it's the kind of error that can really get you into trouble. So, before we dive into the juicy stuff, the exclusions, we gotta lay down the law. Let's call it the golden rule of IAS 2. It's super simple, really. Inventory cost includes all the costs to get the product to where it is and in the condition it's in. Think purchase price, conversion costs, basically anything necessary. Got it? Cool. Because everything else we're about to talk about breaks this rule. All right, to make this stick in your brain for the exam, we're gonna follow a product on its little adventure. We'll start right where it's born, the factory floor. And trust me, this is where things can get messy.
So picture it. You're in the factory, there's a loud clank, some sparks fly, and a giant machine just dies. And an entire batch of raw materials? Totally ruined. Useless. It's a complete disaster.
Okay, here's the classic LECPA question. What do you do now? As the accountant, do you take the cost of all that wasted stuff and just roll it into the cost of the inventory that actually made it through? What's the right call? The answer is a hard no. A big fat expense it immediately. You see, IAS 2 is super clear on this. Any abnormal waste, materials, labor, whatever, hits the income statement right away. And the logic behind this is so important. You can't hide your company's screw-ups inside your assets. That's just bad accounting, plain and simple. It would make your inventory look more valuable than it really is. All right, part one of the journey is done. Let's say we have some good products that survive the factory floor. They're all packed up and ready to go. So what's next? Well, now they're shipped off to a warehouse, just sitting there on giant shelves waiting for someone to buy them. They're finished, they're ready, they're just waiting. And of course, that warehouse isn't free. You've got a hefty rent bill coming in every single month. So the big question is, does that rent money get added to the cost of the inventory? Do you capitalize it?
Generally, nope, not at all. Storage costs are almost always expensed as they happen. But, and this is a huge but for your exam, there is one major exception. You can only capitalize storage costs if the storage is actually part of making the product better. Think about aging a fine wine or a fancy cheese. The waiting is part of the process. For pretty much everything else, though, rent is just an expense.
Okay, let's leave the dust of the warehouse behind. I want you to zoom out with me, way out, to the nice, air-conditioned corporate head office. You know, where the finance team, HR, and the big bosses have their desks. Think about all the money spent there. The CEO's salary, the HR manager's pay, the rent for that fancy downtown office. Do any of those costs get attached to the boxes of product sitting back in the warehouse? You probably guessed it, another big no. Admin overheads, they're expensed, always. The key word here is directly. Does the accountant's salary directly help build the product or get it into its current condition? No. It helps the business run for sure, but it's too far removed. So it's an expense. Okay, we're almost there. This is the last leg of our product's journey. It's been made, it's been stored, and now it's time to make some money. Let's talk about the final mile, the sale.
Boom, a customer just clicked add to cart and checked out. Instantly, a whole chain of events kicks off. Marketing emails fly out, the sales team gets their commission alerts, and someone in shipping is taping up a box.
So what about all of those costs? The fuel for the delivery truck, the salary for the sales team, the money you spent on that TikTok ad campaign that went viral? Do these count as inventory costs? This is the easiest one to remember. The answer is never. Not even a little bit. Selling and distribution costs are always expensed. The logic is just perfect. Inventory costs are all about creating the asset. Selling costs are about getting rid of the asset. They are two totally different things. Okay, deep breath. we've been through the whole journey. Now let's boil it all down into the ultimate study hack. This is your cheat sheet, your shortcut to acing these questions. All right, get your phone out, screenshot this, tattoo it on your arm, whatever you got to do. These are the 4 big red flags, the 4 costs you will always expense. Number 1, abnormal waste. 2, storage costs after production. 3, general admin overheads. And 4, selling and distribution costs. See one of these? Bam, it's an expense, no hesitation.
So we know the rules, but let's ask the big question. So what? Why does any of this actually matter in the real world?
Well, here's why. It's all about the financial statements. Look at the difference. If you screw up and capitalize these costs, you're faking it. Your assets look bigger than they are, and your profit is puffed up. But when you do it right, when you expense them, you get a true and fair picture. This is the difference between good accounting and, well, really bad accounting. This quote just nails it. The whole point of these rules isn't to make your life difficult. It's to make sure companies aren't playing games, not inflating their profits by overstating inventory, and not hiding losses by understating it. It's all about honesty and accuracy. Okay, I'm going to leave you with one final challenge to really bake your noodle. We know you expense selling costs, right? But when you calculate net realizable value, NRV, you have to subtract the estimated costs to make the sale. So what does that include? Is it all selling costs or just the extra incremental ones for that specific sale? Ooh, that's a level up question, but it uses the exact same logic we just talked about. Chew on that as you study. You've totally got this. Now go crush that exam.